Good evening and welcome to this Careers in Finance presentation by Utkarsh Choudhary. Um, I would like to welcome all the participants. I'd like to take this opportunity to thank Utkarsh for taking out his precious time to talk to our students about careers in quant finance. I'd like to lay out the ground rules for this session. As you all can see, this session is being recorded. If you would like not to be recorded, please keep your microphones and videos switched off so that you're not being recorded. The other thing that I would like to let you all know is if you would like to ask any questions, feel free to chat your questions in the chat box. And whenever Utkarsh wants to answer your questions, when Utkarsh pauses for your questions, we will read out those questions to Utkarsh and he will be able to answer those questions. I would like to start off by introducing Utkarsh Choudhary, our guest for the day. Utkarsh, thank you once again for being with us. Utkarsh is currently working as a senior financial engineer at Intercontinental Exchange. Prior to that, he has worked for 2 years in the research signals team of IHS Markit, which is now part of S&P Global Market Intelligence. His responsibilities included conducting research on alternate data sets to develop alpha signals in different asset classes: global equities, fixed income, cryptocurrencies. He has completed his master's in quant finance from Rutgers Business School and a bachelor's in engineering from SKN COE, Pune. With those few words, I would like to now welcome Utkarsh for his presentation.
Yeah, Shazad, thanks for inviting me and thanks for giving me this opportunity to share whatever I've learned and give back to the tech society. So yeah, first of all, let me share my screen. And I don't think I need to go over my introduction again. I think Shazad has given a pretty accurate introduction of my background. So let's get started with my presentation. So yeah, so today's agenda will be, I have one research project, so which I worked on when I was in working in the research signals team at IHS Markit. So that's called factor research. And then we'll talk about some careers points in quant finance. So, so this is the contents. We'll talk about some of my personal background. It will be similar to introduction which Shazad gave earlier. Then I will talk about factor investing for those of you who haven't heard of the concept behind it. And then we will dive into the actual research and the results. And later on, we can discuss about some of the slides I prepared for some materials that can help you if you are like trying to pursue career in quant finance. Then we can leave room for question and answers. Okay, so a little bit about me. So I just joined as a senior financial engineer at ICE Fixed Income. That's in the office is in New York City. So here we have different products related to fixed income analytics, and our clients are mostly mutual funds, buy-side hedge funds, and some sell-side banks as well. So my job is to see what kind of you can say features or analytics our clients want and make sure that they are calculated accurately. So my current role involves a lot of background knowledge in core concepts of fixed income, then also structured products, and also involves programming in Python. Before that, I worked for around 2 years at IHS Markit Research Signals. There, I also interned before joining full time. So that's how I got the full time offer there. And during and how I got internship is that I had some relevant projects in my second semester of my master's program at Rutgers, like where I developed some. I explored factor investing and financial modeling, and then I was also familiar with like some of the different asset alternate data sets. So that's why they liked my background, and I was able to convert that internship into full time. And before that, so this experience in India, the Accenture services, so that was a programming heavy experience. So that is also one of the things that can be beneficial for a person who's trying to develop career in quant finance. Like you have to have strong background or experience or interest in core concepts of finance or programming or mathematics or statistics. So I had strong experience in programming, and my engineering background also gave me some theoretical background in mathematics and some concepts like operation research. So that's why I think I was a good fit for the maths like quant finance program, and also it was mainly about my interest. Uh, so let's start with the intro to factor investing. So I would like to ask anyone if you guys have heard of factor investing. What is it? Have you heard of CAPM model, Pharma French model? Anyone?
Feel free to unmute and speak if you would like to. Otherwise, you are welcome to chat the replies.
So basically, factor investing is an investment approach that involves targeting specific drivers of return across asset classes. Now, what does this mean? So basically, it's like you invest in a you. It's like factor investing divides the investing as whole in a different modules. Like you invest in a modular fashion. So factor basically you can consider it as a style or a theme. So if you want to invest in economic growth, you can invest in that. Inflation, liquidity, emerging markets, credit. So these are some of the themes which come under umbrella of macroeconomic factors. Then there are style factors also. Now, what does this mean? Momentum factors. So basically, momentum factors. Momentum style means that a stock which has a upward price trend. So it means it looks like it's overvalued, but still it is expected to go high. So those stocks are considered under a momentum factor. Now that's the first step. That is, you decide which style you want to invest, and then next step is how do you have a metric to decide whether a stock is momentum or values, whether that stock comes under value style or momentum style or any other size or quality. So for that, you need different company metrics. So for momentum, you can look at the volatility, change in price, standard deviation, these things to calculate whether this stock has momentum or not. Same way to calculate value, you have a lot of attributes in the financial statements of a company with which you can find whether this firm has value or not. So that way, this is like a well-established research done till now, and these factors, the one before here, macroeconomic factors and these style factors, pretty much sums up all the research done in the space of factor investing so far. And this is a slide which says that approximately 70% of all active returns. Now, active returns mean that return which is over a given benchmark, and then benchmark can be risk-free rate. So whenever you talk about active investing and investing in general, you have to compare your results, return results over the benchmark, and you have to have a benchmark. So usually it's risk-free rate, or it can be a market portfolio. So market portfolio can be S&P 500 index or any other index which represents market in general. So 70% of all active returns on the overall fund can be explained by exposures to systematic factors. And these are the, again, the same factors which we talked earlier. And these are the different combinations of factors. Like if you just take size, value, momentum, then you can explain 83% of returns variation. Now, I'm not sure if you guys are able to follow this, how these numbers come, but this is usually done by performing a regression between stock returns. And how do we calculate returns? Basically looking at the close price, daily close price of all the stocks. And then on the X variables are size, value, momentum. And then we perform the regression and then look at the R square. So that's how that for this regression, the R square was highest. And for these different combination, it was little low, but on average, using these factors has high return explainability. Now, what this means, return explainability? It means that those returns, those high returns or low returns, can be attributed to these factors. That's what it means. And here also you can see that how mutual funds have their bets. So they are specifically invested in style. I think I got the color same, something wrong here, but it was around 33% each in style, specific, and industry. So that shows the importance of factor investing. And this is another like a graph between risk and return. As you can see that value stocks and momentum stocks have high returns, high risk, but still they have high returns. Then minimum volatility, they have low risk but low return. So that way, if you consider the risk constant, so for this level or say this level, then as you go up, the style becomes more favorable. So you can say equal weighted is equal weighted type of investing strategy is better than MSCI World. Then momentum is even better. But again, this is for this period, 1975 to 2021. If you take dissect this returns and look at the yearly performance, then it can vary. So yeah, so these are some of the things like that's factor research is a well-established kind of investment philosophy. And what is the future of factor investing? So basically, what you try to do is look at different alternate data sets and try to develop factors or investment strategies. We call it alpha, which is uncorrelated, because I may develop a so let's look at this one, momentum strategy. So I may develop a new strategy which is again momentum but a different metric. So that may also give me good returns, but the thing is it's not unique. It's highly correlated with my existing factors, so it's not very useful. So that way, our main goal with new research is to make sure that the factors are uncorrelated with the existing factors. So that's why at Research Signals, always we have aimed to pursue research in conducting research on alternate data sets. So for my research project, I chose a Ravenpack data set. So this data set has sentiment analysis done based on news on global equity space. So it has news articles mapped to different organizations, currencies, commodities, companies. So that's a stock and places also. So this is the coverage of this data set. And here they have their own NLP methods to assign sentiment values to all these to a sentiment value to every news article. This is just like a which edition we used. So we used this Dow Jones edition. So that's just different sources, news sources. So we had these four: PJ Newswires, WSJ Balance, Market Watch. Uh, yeah, starting from 2000 till 2019. That was our like data set, and it had 34 feeds, and it was delivered daily 4 times. Uh, Now you must be wondering what are those sentiment attributes, sentiment fields. So there were around 40, and these were the main ones: relevance, ESS, ENS. So ESS means event sentiment score. ENS means novelty score. So this sentiment score varies from 0 to 100, 50 being the neutral sentiment, below 50 is negative, and then above 50 is 100 positive. And novelty score means how novel or how unique it is, because the same, remember, we have these different news sources, so same news can be reported by different news sources. So to penalize those duplicates, uh, we have a novelty score attached to every news, and every news is uniquely identified by this Ravenback ID, or I think it's also called entity number, something like RPID, yeah, entity ID. So that's how we map every news to every security in our security master, because you have to map those news to every security, because our universe, we are only concerned with map news which is uh, attached to a given company, because we have coverage to all organizations and currencies, right? So we don't like currencies or commodities, but we want news only around companies and organizations. So that's why mapping is important. So those were the initial steps, you can say, exploratory data analysis, where I had to filter these news, because there were around 4 million rows for around 5 years of data. Because you imagine every day, for every around 7,000 companies, there is all news covered. So the data size was huge. So first, my filter was basically removing all those which have like duplicates, scores not equal to 100, because 100 means unique in the ENS, and that decreased the size of the initial data set. And then my next step was to make up some hypothesis around investing. So the first one was basically the standardization of the sentiment score. But that sentiment score, this cent I, is aggregation for last 24 hours, because you can't look at every minute. Our trading strategy was holding period of 1 day, minimum 1 day. So I aggregated sentiment for previous 24 hours and then normalized them using the standard deviation of last 20 days, so that the graph has less spikes. So that was the first idea. And this is the filter, like relevance, it has to be 100% relevant to that company. Then it should not be 50, because 50 is like neutral news. It's not adding any value. And then ENS, max ENS. So basically, whatever the maximum novelty score is available on that day, we are choosing that. Then second one was using the exponential weighted sentiment score. So this is a similar to the first idea, but it's not using the raw sentiment, but the normalize sentiment. Then another idea was this sentiment strength. So here you will see two different weighting schemes, W1 and W2. So here you will see W2 has this 10 multiple and W1 doesn't have that. So basically W2 is a faster degrading function and W1 is a exponential function that degrades strength by elapsed time. So since in this factor, we are aggregating sentiment for past 90 days, we have to make sure that we are penalizing those news items which are very old. And we want to compare companies like Google, which may have a lot of news even today or before that in past, and also new companies which may have only very less number of news for past few days and even the same day. So take care of that. I had created two different weighting schemes. So just wanted to zoom out a little bit here, that we have to create these kind of hypotheses, you have to have some intuition around the data set, and you may have to have some idea that what can work, what can not work, and then proceed with like testing these hypotheses. So I had in the presentation I only included 3, but earlier originally I had created around 8 similar kind of ideas. So at this point it was all theoretical. Then the next step was actually to test these strategies. So to test these, the process is called back testing. You must have heard it. So basically we do a simulation and see how this would like these strategies would perform. Basically I will tell my simulation to buy and sell based on these strategies. Now in back testing, I didn't include in these slides, but I just want to talk a little bit here that in back testing, there are a lot of biases. So you have to make sure that you address them, like look ahead bias, survivorship bias. So that's very important. Otherwise, your back testing or your results may not mean anything. Any questions so far around back testing, biases, anything? Okay. So this slide represents how we were able to map the initial data set, Ravenpack data set, to our scripts. So yeah, originally this slide was meant for some internal process, so may not mean anything right here, but just wanted to highlight that. But whatever research you do, you have to make sure you are able to map it to your existing data set. So our existing data set will be the stocks, right? So security ID, basically security means any stock. So every news should be able to be matched with existing stocks. So that's what this represents, that I used RPID with the security ID, and then created factor outputs and then linked it with MATLAB, because our existing production system was in MATLAB at that time. Again, this is just some internal process. I thought I would just include it here to show that we have different identifiers for every stock. So security ID, integer ID. Usually, every data set would have multiple IDs, because if this integer IDs, right? These are like if you are working on arrays, array in NumPy, then that processing is very fast compared to string. So that's why sometimes we'll have both string ID and the integer ID also. So, and also there are sometimes there are issues with using QSIP and ISIN. So QSIP and ISIN are standard identifiers of stocks. So sometimes you have to buy licenses, and the client or any firm may not have license to use that. So firms like IHS Market will create their own ID, integer ID, so that using the QSIP or ISIN, so that they can share that ID and those stocks with the client. So that's like one way of, you can say, problem solving process. like circumventing through any kind of licensing needed. So this is the results. So let me share with you what it means. So these are three different factors we discussed. Raw, that was the first one. Second one was RP1, and the third one was sentiment strength. Uh, Now, what this means: one day open to close average return. So that means for that day, what was the close open price and the close price, and the difference, the return percent between that, and average during the whole back testing period. So for that, for first it was 0.35%, and then for sentiment it was 0.19 and 0.22. Hit rate, that's interesting. So hit rate basically means that uh, for how many times your strategy is saying has predicted the direction right, the direction of the stock movement right. So basically, 60% here, 60.5 means 60% of the time strategies said this factor said stock will go up and it went up. So usually this is also a good metric, because if it's less than 50, then it doesn't even make sense to invest in that factor. You can just toss a coin, right? Because that's like 50% chance. So that way, and then D1 minus D10, what does that mean? So first of all, let's talk about coverage. Whenever you create any strategy, investment strategy, you have to have high coverage, because in this data set, the problem was with the coverage, because uh, you may not have news for all the companies every day, right? So this is like inherent problem with this data set, that it is bound to have low coverage. And then D1 minus D10, usually what we do is, if you've heard of uh, uh, long short strategy, so that is dollar neutral strategy. So if you want to create your strategy dollar neutral, you have to like rank your stocks in different deciles, decile 1 till 10, and then go long on top decile and go short on bottom decile. So that's called long short dollar neutral strategy. So that's what it is, D1 minus D10. Uh, uh, and this is again detailed zoomed in version of coverage. So, and at the bottom, the D1 minus D10. So you can see that for 2018, for this sentiment strength, the performance was better, and for 16 and 17, it was lower. Uh, and I can explain to you why that happened. Like, one insight I was able to infer from the research was that at this time we witnessed a lot of negative news. So based on negative news, the factor will say you have to short it, right? But the thing is, uh, whenever you short stock, at least for this universe, US total cap, it had a huge tendency to bounce back. So when it bounced back, our returns were lower, because we initially the factor initially said to go short. So that way, that was like an interesting insight, that you're supposed to trust your long go long, meaning buying signals more than your selling signals. And this is a uh, correlation chart. So SMA factor, what is this? This is a similar data set which we have, which were not news sentiment but Twitter sentiment, and I calculated the correlation between returns, because if we have an existing sentiment data set, we have to make sure that the new data set is not correlated, right? We are supposed to create uncorrelated factors. So that's why I draw. So these raw S score, S mean. So these are the factors created from the different data set. So you will see that correlations are less than 60. Only just this one, S score and RP1 is in 60s, but everywhere the correlation scores are pretty low. So that gave us an idea that, yeah, this research holds this data set holds some value. So yeah, so we were able to get high alpha value for low correlation with SM factors. That was the conclusion for this research. And there were some other ideas which I explored for this project. So abnormal sentiment volume, abnormal news volume, normalized AES for 90 days. So yeah, so that was my research part. Any questions so far?
Please feel free to turn your mics on if you would like to and ask any questions for Utkarsh.
Oh, I see that there are some questions. Okay. To be quant analyst, what skill sets should we have before we graduate? When the back testing was done, was the neural network wait. So I will address this quant analyst part. It will come later in the presentation. This question is by Gabriel. When the backtesting was done, was the neural network retrained every few virtual days to try to forecast, or the training set was totally uh, spared from the testing set? Uh, so yeah, so this in this project, I did not use any neural network, but whenever you have a machine learning problem, only at that time you're supposed to have a training and testing set. But in back testing results, uh, uh, I used all the data set available because it's very important to use all data set because this is a time series data set, right? So the closer your data set is to the present time, it will be more accurate. So the return results from say Radner's 2022. So return results from 2021 will be more accurate towards the results that may come in 2022. So that way I utilize everything. And I understand your question, but this kind of segregation only comes when the problem is a machine learning type of problem. So this is not a network or a machine learning problem. Was the far past positively influential in the near future prediction? What do you mean? Can you repeat? Or can you talk? What do you mean? Was the far past positively influential in the near future? Oh, you were saying how was my out of sample prediction? Yeah, it was not far, but the close past was influential in the near future prediction. We did some out of sample sampling test as well, and we found that wait, so results were similar to this graph, like 18, 19, 21. So that way. Any other question around the project? For example, when you trained for 20 years, the 20 years last year useful for prediction next week. Yeah, that's true. That's true. That's usually the case, but you have to train your model for all the data set right available. So, because there are a lot of cycles also in these kind of would that be due to generalization? No, it's because of the time series nature of the data set. Because it's you're going in the past and then coming to the future, right? So it's mostly because of the time series nature of the data set. If the data set was cross sectional, then it would have been we would have done this process which you mentioned, the cross validation, basically dissecting everything into training and testing. Okay, so let's move on to the next part of the presentation for careers in quant finance. So here I should have had an index, but here I'm going to talk about some of the resources which you can use, which I have used during my preparation, and some techniques, tips, so general stuff around quant finance and what are the career paths in quant finance. Uh, so these are the list of few books, 3 books, which which will give you a brief introduction about uh, how it is to work at a quant job. What are the different roles? So this one on becoming a quant, you all everyone who is interested in quant finance becoming a quant should give it this one a read. It's very small, 50 to 60 page. Sorry, 50 to 60 pages. It will explain you what different roles are and how you will get paid and like working hours, future prospect, exit strategies, everything. So similarly, this interview preparation, this is a like intro level preparation for quants, and then this is also the second book is a general guide to getting a quant job. But the first one you guys must read it. It's very small and it will develop your interest and feed your curiosity. Now the question is why prepare for quantitative interview? So basically, thumb rule is that grad school acceptance rate is around 10 to 30%, and quant finance interviews acceptance is less than 10%. So it's like it's highly coveted field, and it is paid well also. And recently, since last year, the uh, pay has gone really up, and there is a huge shortage in even in quant space. Those who have some level of experience. So here you can see the quant pay in North America. As of August 21, I highlighted that because now it has gone even higher. So usually when you graduate with masters, you join an associate level. So you can see the base salary is around 125 to 160. Then on buy side, it's even higher, like 115, 200. And as you have more experience, your basic base salary increases, and then total compensation also increases. So right now in some of the investment bank roles, uh, VP level, this salary is this salary. So actually VP is around 700 now since 2022. So this field is very lucrative, and as you gain experience, as you collect experience, you start getting more, you start becoming more valuable, and you can demand more strategy. Salary. So I thought I will include this slide so that it might motivate you. So these are the must must have books if you want to prepare for quant interviews. So these 3, starting from the third one. So usually we call it green book, red book, and orange book. Orange or yellow, I forgot, but green, red, and yeah, these 2 are well known. This third book is a little difficult. The middle one, it's the third on the street. It's difficult and thick book. But the third one, this Practical Guide to Quant Finance, that's a must-have. It's around 200 pages. It has everything, programming, foundations of financial concepts, financial modeling, factor investing, as I said, optimization, then puzzles also, Black-Scholes model, so stuff like that, options, derivatives, fixed income, so all that stuff. So this is a good start, and you should go through this book multiple times, at least 2 to 3 times. And these 2, you can treat it uh, to prepare yourself even more if you want to go in depth. But this book will prepare you for maybe 70 to 80% of the interviews, the green book. So let's talk about, also any questions so far about the books or preparation? Okay. So what sort of quants are there? So there are different types of quants. First is the front office desk quant. It basically implements different pricing models directly used by traders. Uh, the pro is that it's close to moving and opportunities to move into trading. So one thing is when you get a trading job, it's very easy for you to move anywhere because it's very highly coveted. So uh, it gives you a lot of mobility and different exit options, or like say different career alternate options as well. So you have a lot of backup if you land up here. And at all, if you decide to change your career, because it's stressful and demanding depending on the firm, and it may or may not involve research. Like recently I learned about one trader who's around 29 years old, and he just joined Credit Suisse. And before, he was just a senior trader at BNP Paribas, and then he became VP at Credit Suisse, and immediately they gave him around 700 million of PNL. So that's a big amount for anyone who's so young. And he made around 100 million profit uh, by investing in, no, but not investing, but by market making uh, of Russian bonds. Because the thing is, currently no one is interested in Russian bonds buying. So there is a huge liquidity gap, and he was able to demand any price for whoever was buyer or seller. So that way he made a lot of money. So that's just highlighting one thing that about front office desk quant traders. So like the opportunities uh, endless. Then model validation quant. So here, what they do is model validation quant. Uh, Here, your pro is that you it will be more relaxed, less stressful. And another pro is that you may not have to develop a lot of models, but you will learn a lot of models. So it will be very knowledgeable without much effort from your side. But yeah, as you can see, con will be that it can be uninspired. It's not very fast paced, and it's far from the money. So I'll get to it what this means: close to money, far from money. So, okay, I will just go to that. Did I okay, I think I forgot to include it. Uh, okay, anyway. So basically the thumb rule is that as close you are to the money, you will make more money and that role is also difficult to get into. So front office, it's closest to the money, and that's why it's highly sought after and highly paid. Then model validation quant is less paid, and that's why it's less stressful, more relaxed. uh, Research quant. So that's also different. It's like so you can say my role was similar to this at IHS Market, research quant. So here, this slide says research quant tries to develop new pricing approaches, but research can be conducted in any process, right? So yeah, pros is interesting. You learn a lot more. So and you end up learning a lot of things on your own, and you learn things, how things are done end to end. And cons is sometimes hard to justify your existence. Yeah, I think because you only get couple of projects every year on research. Otherwise you're busy with like business as usual tasks. Quant developer, yeah, that's just programmer. That's it. It's just, I think, glorified way to title a programmer, but it's a programmer role. So the lot of earlier jobs were in C++. Now jobs are in Python, because a lot of I think all of banks have migrated to Python from their legacy systems, and hedge funds, I think they are already operating in Python. So for this, if you're good at Python, you like coding, but you want to stay close to the financial world, I think quant developer role is for you. Yeah, statistical arbitrage quant. Basically, you try to find arbitrage in different markets. So yeah, return on this type of position is highly volatile, because usually whenever there is arbitrage, it gets vanished very immediately, because almost all the markets right now are very efficient, uh, except crypto market. Then yeah, so I think since crypto market is evolving and being accepted everywhere. That is giving opportunities, giving a door for opportunities to statistical, whoever wants to be a statistical arbitrage quant. Capital quant, yeah, that's just a modeling uh, in different bulge bracket banks, and it's not derivatives pricing, but models can be uh, like stress testing, CCAR, so those kind of stuff. This can also be considered similar to risk management. So these were all the rules, right? Uh, any question around the roles before I move on to different type of employers?
I don't see any questions yet, Utkarsh.
Okay. Yeah, so type of employers, I just made this slide so that you can have a zoomed out version of where you can end up. So commercial banks, they ask less of you and they pay a little less. Although it's changing now for experienced candidates, but yeah, compared to other industries, other firms, they pay less, and job security is also high. The investment banks, yeah, they have high long hours, and yeah, job security is also not that great. But this investment bank job provides you a great exit opportunity. You can go away from money to back office. There are a lot of jobs. So the hedge funds, yeah, they have they demand a lot of work, and the potential to make money is unlimited at hedge fund. And the thing is, if you want to lead, if you want to end up a quant researcher or portfolio manager at hedge fund, you should just aim to land any kind of job on buy side. So that's hedge fund, and then internally you can switch. So that should be your goal. If you want to like if you want to end up in a hedge fund, you don't have to like get sad that you're not able to get first job after masters at hedge fund, because it's very tough. uh, okay, but it will be worth it if you like land any kind of jobs, maybe say risk analyst or operations role, and then switch internally. Yeah, so last type of firms is the accountancy firm. So that also includes consultancies at PwC, Deloitte, these firms, and also insurance companies. So they also hire quants, but their work is very. I think it's similar to BAU task. You need some programming skills, SQL, Python, and you have to do some BAU task around their existing projects. And your projects keep changing. So one of the disadvantages is that you may have to learn some legacy system which may not be useful right now. For example, right now it's SQL and Python, right? But you may have to learn Scala or any other legacy system software. And the pay is also low. I mean, the bonus structure is also very awful at accountancy firms compared to the firms I talked about earlier. If I want to develop new forecasting algorithm with the team, which is the best new forecasting algorithms, right? So that's basically comes under forecasting. I don't know forecasting, but if you're talking about pricing, then capital quant. Yeah, for forecasting, capital quant will be there. It's also called modular these days, quant modular. You will find these at bulge bracket banks like UBS, Capital City, then Barclays. And you can also consider career in model validation. So usually these firms, these banks have model validation team, then model developer team. So yeah, so for you that will be a model developer role or quant modeler, or I think they also call it model strategy role. So yeah, you can look for modeler roles. I think it comes under model validating quant as well. So model validating quant and the capital quant. Yeah. Any other question? Non-technical analysis as well. Yes. The definitely. Wait. This one. Yeah. Model validation. Yeah. So don't think that for any bank you work here, you have to have do a lot of documentation, because it's not just you or your internal teams which are stakeholders, but the clients as well. And in banks, you have to have when you create a model, you have to be responsible for how it performs. So when it diverges from the expected results, you have to explain why. So it's like you are the model owner. So for that, there is a lot of documentation involved. I think I will say 70 to 80% documentation, because once model is done, then your work is done, and then there is a lot of documentation. So you should be ready for that. And another I won't say disadvantage, but one thing is that uh, they rely on a lot of not rely, but they have expectation that all the models are explainable. So that's why they are not diverging towards machine learning so much, because the models are not explainable. So they usually rely on only regression, unless there are new machine learning models which are very explainable, right? So I don't think they will ever opt for like neural network or such kind of CNN type of models. That's one thing. Question. Can you? Yeah, sure, no problem. I will share the presentation. So yeah, so to sum up, Gabriel, non-technical analysis. I won't say analysis, but yeah. I don't think any kind of analysis is non-technical. I don't know what you mean by non-technical analysis, but you have to do analysis like if your results, your model behaves in a fashion which was earlier not expected. You have to have some accountability for that. So that was about the bulge bracket bank roles. I did not cover data science roles, but quants are also eligible for data science roles, and they are everywhere. Data science roles are everywhere, even in the wait. Let me go to the slide. Employers, yeah, in commercial banks, investment banks, hedge funds, accountancy firms. So everywhere data science roles are there. So if you want to explore new kind of models and stay very hands-on with coding, I think you can go into data science. But as the world progresses, everything, the data science is being turned into a IT kind of responsibility. So you may be away from all the decision making and all the deployment of the machine learning models. So I think may get boring. I don't know. Just guessing. CFA, yes, CFA is very useful. I will say both, because it's very huge. So I think you should prepare for CFA. A lot of firms, in these firms in banks, there are a lot of people who are old-fashioned, so they seek CFA. It may not help with in interview. So I think if your interview is coming up, you should focus on coding and interviewing skills rather than CFA. But if you're in the school, you should definitely clear at least one level. Okay. Does this field offer sponsorship? Yeah, but I don't think you should wait. I also waited that my firm will sponsor my CFA, and I'm still not even level 1 cleared. So I don't think you should do that. You should pay on your own, because you will get paid a lot when you're in the industry. So don't worry about that. Don't worry about sponsorship. It's only $1,000. Oh, H1. Yeah, definitely. Not all, but all the big firms, they do. There are some firms, let me go back to the firms, hedge funds. There are a lot of family managed hedge funds. They don't sponsor because they don't hire. They even don't hire very on a large basis. So they are very lean fashion firms. You can say boutique firms. You shouldn't worry about that. There are a lot of firms which hire on H1B. So So this is a checklist, like stochastic calculus for finance, discrete time models, Black-Scholes, derivatives pricing, hedging, fixed income modeling, portfolio optimization. I think if Shizat can share with you this slide, you can go through these. I included these as a checklist that you should be prepared. And C++, I think instead of C++, you can focus on Python. Then these are different sets of ratings to have some real life experience of some people who are in the this field, who worked on Wall Street, and what they say about how their experiences were. So this slide shows some ways of networking. So this is me at volunteering at Battle of Cons. So that was one of the events. To get in this event, you have to pay around $500. But I just asked the event organizers, can I volunteer? So they allowed me, and I got the free pass, and I was able to meet a lot of people in this field. It was in the New York Public Library in my second year of masters. So sorry. So yeah, so these are some of the points, like group mates, close friends, whoever you came in contact with, you should contact them and ask for any kind of reference if they can, because usually the firms give a huge bonus for referral. So if you are good enough, people will be happy to refer you. Then you should attend seminars like this, volunteering for conferences, job fairs, campus recruitment, and the kind of exposure you get with the real world, you should get that. And then also LinkedIn is there. And yeah, so before closing, I'd just like to say the difference between the ordinary and the extraordinary is that little extra. So I think you should try your best, because this field is very lucrative.
Thank you, Utkarsh. There are a couple of questions that have come in.
Sure.
One of the students, I think you've actually answered that Python would be more useful than C++.
Yeah.
Awesome. And then the other question is about, do you get to trade real money, or can you see your model is being used somewhere?
So this model, I just market it as an analytics firm. We don't trade our money. We make those strategies, and if our backtesting looks good, if the clients agree, they subscribe to our model. So on a daily basis, before market opens, we tell them where to buy, how to buy. So basically, we are not investing, but they are investing on our model. And based on how many clients are subscribing to this model, that much amount of money was going into this strategy. So I didn't do that, but our clients did invest in this strategy.
Awesome. Thank you so much, Utkarsh. We are at time, so I would like to take this opportunity once again to thank Utkarsh for the time and the advice that you've given our students, walk them through different careers as a quant. I think that information is very, very helpful and useful. I'll be happy to pass these slides on to the students. Please send me an email, whoever wants a copy of it. Utkarsh, whenever you get a chance, please send me a copy and I'll be happy to pass.
Oh yeah, I will after this call.
Awesome. I'd like to remind all the students that we have shared with you a link where we would like to have your feedback. So please feel free to share your feedback with us on this session. We would like to know what you feel about this, how you feel about it, and we'll be happy to see what changes you would like us to bring about. I'd like to also remind you that we have a couple of more sessions coming up in this month, April 20th and 21st. Please take a look at Handshake. Please take a look at the newsletter, what's next for the events that are coming up next week. I'd like to once again thank all the participants for participating in today's session. And once again, Utkarsh, thank you very much.
Yeah, no problem. It was a pleasure. Best of luck, everyone, with your job search and everything. Yeah, you guys can reach out to me on LinkedIn.
Thanks.
Thank you.
Bye-bye.